Hi, everyone. We'll start in 5 seconds. Hello, everyone. Welcome to Phillip Roundtable. My name is ST, and I will be your moderator for today. At the most recent FOMC meeting, the US Fed increased its benchmark interest rate by 75 basis points in response to growing challenges and rising inflationary pressure. In these trying times, how do we find the possible opportunities? We are pleased to be able to have industry experts in today's Phillip Roundtable to discover potential opportunities amid mounting challenges. Before we proceed to introduce the panelists for today, we would like to share some great news with all of you. Our 12th Phillip Investment Conference is back, and it's going to be bigger and better this time. Do join us if you are looking for in-depth financial market insights from the top professional industry leaders across Malaysia. The registration link is up, and you may scan this QR code to get more information. Without further ado, let me introduce the speakers for this Phillip Roundtable. First and foremost, we have Mr. Lim Chia Wei. Mr. Lim is a portfolio manager in Affin Asset Management. He is the portfolio manager for the Asia ex-Japan equity funds. His stock and macro research coverage includes Korea and US. Prior to joining Affin Asset Management in June 2015, he was an assistant manager in Public Mutual Berhad, where he covered China stocks and Asia telecom stocks. Chia Wei graduated with a bachelor's degree in computing, majoring in software engineering from Staffordshire University, UK. He is a chartered financial analyst charter holder. Next, we have Mr. Derek Yee. Mr. Derek is a Managing Director, Equity Portfolio Specialist for Asia Equities in Manulife Investment Management. He is based in Hong Kong and is a Managing Director responsible for the coverage of all Asia-Pacific equity strategies. He works closely with the Asian equity investment management teams and is the primary resource for communicating the key features and attributes of the company's Asian equity strategies to existing clients, prospects, and consultants globally. Derek has over 17 years of financial industry experience. He joined the firm from Standard Chartered Bank, where he served as Director, Asia ex-Japan Convertible Bond Sales. Prior to this, he was Vice President and Equity Analyst at Nomura International Hong Kong. Before this, he held equity research positions with Merrill Lynch in Hong Kong and Franklin Templeton Investments in the United States. Derek holds a Bachelor of Science in Business Administration and Management from University of California. Last but not least, we have Mr. Muhammad Aiman Reza Anwar. Aiman joined Nomura in November 2014 as a trainee of the company's graduate trainee program and was attached to the middle and back office departments, in addition to the investment departments. He is involved in new idea generation and reviews of existing investments in the global equities portfolio management teams in Kuala Lumpur and London. His responsibilities also include research coverage of Australia and global healthcare. He is a contributing member of the Global Equity Strategy Committee and the Global Stock Selection Committee in Nomura Asset Management. Prior to joining Nomura, Aiman was attached to the Global Treasury team in OCBC Malaysia. He graduated with Bachelor of Engineering and Bachelor of Commerce, majoring in Civil Engineering and Finance from the University of Melbourne, Australia. Thank you so much to our fellow panelists for joining us today. So let's move on to our first question today. So the first question is, with the announcement of a huge interest rate hike of 75 basis points, what is your view on this? Maybe we can hear from Encik Aiman first on the impact to the US market.
Yeah, okay, first of all, thank you for having me, and thank you everyone for your time and attention. So yeah, my primary coverage is developed markets, and I'll start with the US. The view on this is probably, the longish answer is it depends on what are the factors that are driving the rate increase. But in this case, the short answer is it's not great. So when you've had the Fed raising rates, if those of you have studied finance in school, you know that when the discount rate goes up, then your future stream of cash flows or income, which a company generates in this sort of case, is actually devalued. So stocks have derated in response. And the US market, being a market that's driven by growth, is probably one of the worst affected markets. So year to date, we've seen the S&P 500 or the SPX down 20% because the structural winners coming out of COVID, the likes of the secular growth names, Apple, Amazon, Facebook, Microsoft, and the likes, have come off quite sharply. So you've seen Amazon, which is obviously an e-commerce giant, a growth company, has substantial market share, very profitable. It has pulled back 35% year to date. So yeah, I think that's been one of the biggest impacts. So Amazon, which is something that is a bit more insulated compared to some of the unprofitable growth, is seen as more quality growth, has fallen a lot. And yeah, we can probably touch on the consequences of what the Fed is doing later on, but I think I'll stop there in terms of the impact to the US. So I would say, yeah, the growth names have definitely come off a lot this year.
All right, thank you, Aiman. So maybe we can hear from Derek on the impact to India and also a China market.
Yeah, great. Thank you very much for the question. Very happy to be here. Hope everyone is doing well. I think, as it relates to these two specific markets, obviously we're looking at different growth trajectories, different policy measures, both monetary and fiscal. So I'll start with China first. And more recently, the announcement that was made yesterday with regards to the loosening of quarantine restrictions. Now, this is something that we believe has put a cap really on investor expectations and sentiment in China. This has created a lot of different issues, from supply chain to consumption, industrial manufacturing, retail sales. So having a loosening quarantine restriction or a COVID policy is something that we think is going to help drive investor sentiment in China going forward. Now, as it relates directly to interest rates, we don't believe that it's going to have a direct impact because there are a number of different growth drivers for China going forward. One of them, again, is going to be the news that was released yesterday. But more importantly, if we've looked over kind of the past year or so, we've seen a divergence in terms of monetary policy between really China and the rest of the world. So, growth drivers in China are going to be less impacted by higher rates. So we think that, in the second half of the year, all things being equal, and when we say all things being equal, there are obviously a lot of variables that could throw that comment really out of kind of off its path. But all things being equal, we feel that China has a potential for a much stronger recovery compared to the rest of the world. So that's on China. On India, however, the story is going to be slightly different. India, we've seen India raise rates due to higher inflation, both energy and food costs. These are two areas that have impacted other global markets. However, India, when we think about higher rates, when we think about rates being raised domestically in India, this is really kind of to preempt pressure on their local currency. One of the reasons why that's so important is because, as we know, India is one of the world's largest net importers of oil, and as energy prices, oil prices, continue to remain elevated, this historically has really put pressure on India's current accounts because of a weaker currency. However, given over the past 7 years, there have been a number of reforms, there have been a number of different policies that have been put into place to really strengthen both fiscal and current accounts within India. So today, India is able to withstand higher oil prices than it did, let's say, 3 to 5 years ago. But all that being said, if we go back to the question of what is the impact of a 75 basis point rate hike to India, undoubtedly there is going to be some impact. Now, how negative this impact is going to be is really going to be looking at the magnitude. This is really going to depend on, a number of factors. One of the key factors really is going to be energy costs to India.
Thank you so much, Mr. Derek. So maybe we can move to Mr. Lim for the impact to the Malaysia market.
Yep, sure. Hello, everyone. I'll try to break down my answer into two parts in terms of what has happened and what is likely to happen going forward. The first is what has happened is we've already seen the 75 basis points Fed rate hike, and how does that affect Malaysia is really there are a few areas that it affect Malaysia, but one of the most notable is in terms of the impact on bond outflow as well as forex, meaning it has caused Malaysian ringgit to depreciate. What happened is when US raised rates, and on the other hand, Malaysia has not really raised rate as fast as US, the interest rate differential, meaning if you're an investor, in the past you invest in Malaysian bond, but now when you look at the yield in US bond has increased at a much faster pace, you may start to think that, hey, maybe US bond is more attractive. So some global investors, they may sell off some of the bonds in Malaysia and park it into bonds in US. And in the past few months, we've already seen that, in fact, when we look at Malaysian bond market, there has been outflow and bond prices in Malaysia has declined as a result as well. So that's the first impact. Partly and also largely due to this bond outflow, Malaysian ringgit has also weakened because this is money flowing from Malaysia to another country. So it does affect the forex market in Malaysia. Those are things that have happened so far. Then the question is, what will happen going forward? Clearly, Fed is not done with its tightening. The recent Fed guidance is that they intend to continue raising interest rates all the way until it's currently at 1.5% for US Fed fund rate. The guidance is they may increase Fed fund rate all the way to 3.8% by the end of next year, end of 2023. Now, interestingly is, because to assess the impact, we have to assess how is the market pricing, whether the market has already accounted for this 3.8% by the end of next year, or the market has yet to do so. Very interestingly, very recently what happened is the bond market has started to be, in a way, more dovish than the Fed. If you look at how the bond market is pricing in Fed fund rate by the end of next year, they are pricing it at somewhere around 3.6% compared to Fed's guidance of around 3.8%. Now, typically, or rather before the past few weeks, typically bond market is the one that priced in a higher rate hike than Fed's guidance. But now, for the first time in a long time, bond market thinks that Fed will not be able to raise interest rate as much as they think they will. What this means is that if the bond market is right, we are likely to see some relief in bond yield. This whole bond outflow from Malaysia, ringgit weakness, it may see some kind of pause, some kind of stabilization. In other words, you may see US dollar stabilize, meaning it stopped going stronger and stronger against ringgit. So that's how it may affect Malaysian market. The question is, why do I think the bond market is likely to be correct versus Fed guidance? The reason is, historically, the bond market has always been much more sensitive to how the world is developing They're more sensitive to new economic data, economic development. What they're thinking is that US economy is slowing down very, very quickly. And if US economy slows down very quickly and continue to weaken for the next 1 year until end of next year, it typically means that it's very difficult for Fed to be as aggressive as what they have guided. In short, to answer your question, how does that impact Malaysian market? It has already caused bond outflow from Malaysia and ringgit weakness. Going forward, we think these two issues will stabilize somewhat because Fed probably can't hike interest rate as aggressively as it has guided recently.
Okay, thank you so much, Mr. Lim. So to summarize question number one, for US, will probably with all these the Fed raising interest rates, most of the growth companies are affected. As for China, we can see a lot of supply chain issue, consumption loosening, and also with all these quarantine restriction loosening, we might also see China market recovering as well. As for India, there's a little pressure on the local currency. And as for Malaysia, as Mr. Lim mentioned earlier, with the impact on bond outflow, we can also see some Malaysia ringgit depreciating. However, hopefully we will likely to see some relief in bond and also with US dollar stabilizing. So to move on to our next question, May's US Consumer Price Index reading came in at 8.6% year on year, which is the highest since 1981. So this prompted the market price in a 75 basis point hike from the Fed. Markets also broadly expect between 9 and 10 rate hikes from now to early 2023. So with at least 50 basis point increments at each of the next 3 Federal Open Market Committee meetings and a terminal rate of 4%. So just now, Chawi has shared his point of view on the potential rate hikes. What about Derek? What do you think of this? Do you expect there will be more aggressive rate hikes and higher terminal rates?
From a U.S. perspective, I think I'll hand it over to Ayman, who would be the one who covers kind of the developed markets, if you don't mind. So Ayman, I'll hand it over to you.
Yeah, no worries. Yeah, I thought the question would pass to me anyway. As I kind of touched on earlier, US has obviously been the most direct impactee of higher rates, right? And I think Chawe actually summarized it very well. We think that the volatility is probably likely to persist, and the Fed has to act or be seen to be acting in a very data-dependent way. They've not really ruled out another 75 basis point hike at the upcoming July meeting. Tomorrow night, we've got another sort of measure of inflation data point coming up, which is the PCE, the Personal Consumption Expenditure Index, and that's based on the May level. So we know that probably is going to be quite bad because we know that the CPI came in quite ugly as well. So we do think that the volatility will be likely to persist. We've seen the terminal rate projections sort of fluctuate between 4% and 3.5% on quite a regular basis. But I think this is where I'd like to go into a bit more detail on why the Fed has to act and what the repercussions of the Fed action can be, and the impacts will be felt on a more global basis. And there's a dreaded R word that I guess people in our industry kind of hear a lot more these days, and that's the possibility of a US recession, which has knock-on effects into the global world as well. So the Fed does need to continue to act because of the inflation levels in the US, which has been crazy, as ST pointed out earlier. And I think they have to continue to press on. Us as a house here at Nomura, Malaysia, are of the view that even if the Fed pushes the US into a slight recession, provided it's not a hard landing, it's more soft and shallow, then it won't be so bad. A soft and shallow recession is probably the lesser of evils when you compare it to the wage and inflation spiral which the US seems to be stuck in right now. So the Fed previously said last year that they thought that the inflation levels would be transitory. That proved to not be the case. It has been consistently creeping up higher and higher, and as a result, the last print of 8.6%, you had to have wages to come up and cope with the higher cost of living, and this is what is meant by this vicious cycle of the wage spiraling inflation. So the Fed does have to combat this. They have to be seen that they are combating this, because if they are hiking, then at least they've tried. The impact of hiking rates is to actually slow down the demand side or destroy demand. And it's probably likely that they will press on with this for the near term. And so our house view is that we won't rule out further aggressive action by the Fed. And even though this would be even more detrimental to the growth stocks and some of the secular winners that we like, it actually does create like long-term opportunities to get into these names. So I think that's in a nutshell our view here at Nomura.
Thank you, Aiman. Derek, do you have anything to add on to this?
Nope, I do not. Thanks, Aiman.
All right, so I guess as what Aiman mentioned, volatility might persist, and this Fed, they have to act it because inflation in US is currently crazy, and even if the Fed pushes US to slight recession, it might not be so bad, and it might also be detrimental to growth stock, but this is also a long-term opportunity as well. So moving on to our third question. China's government has asked banks to help stabilize the world's second largest economy by lending to small firms and sectors in the last few months. How do you think the China banks are able to earn profit, and how long do you think this will go on? Maybe we can hear from Derek on his opinion.
Yeah, great, thanks. Happy to take that one. So for the China banks, lending to SMEs, this is not something that's new. This has really been a part of the Chinese government's growth efforts, over the past, let's call it, 7-8 years. It's really caught the attention, or it's really come to the forefront after COVID. So we first started to hear in the headlines the Chinese government encouraging the banks to lend to SMEs post-COVID, so in about the end of third quarter, early fourth quarter of 2020. That continued into 2021. And the reason behind this really has been due to the fact of how important small and medium enterprises are to the Chinese economy as a whole. As at the end of 2019, SMEs employed in the ballpark of about 80% of the non-government workforce. So when you think about that number, it's absolutely huge when you're considering that there are over 1.4 billion people in China. In addition, when we think about the small and medium enterprises, they are in strategically important areas, one of them being in technology. So given the impact of COVID, given the recovery, given the start and stop gap measures due to the fluidity of COVID in China, I think the Chinese government really is looking to help provide support to some of these sectors, or to small and medium enterprises, but also sectors that have been, pretty badly hit by the impact of COVID. Now, all of that being said, how does that impact the profitability of banks? Well, banks in China, as they are, particularly the SOEs, they are relatively profitable. Pretty healthy dividend yields, low double digits to mid-teens ROEs, strong, loan loss coverage ratios, with very healthy NPL coverage ratios as well. So fundamentally the banks, especially the state-owned banks, are quite healthy. But when we think about where we are today, the banks, I think, what we would expect is that this upcoming quarter of earnings is expected to be weak. And a lot of that really just has to do with what has gone on in China with COVID and the lockdowns that have taken place. But given, what we expect to see some green shoots in China in the second half, and the strong, loan loss coverage ratios, we believe that NPL formation is manageable, particularly for some of these larger banks. So will they and can Chinese banks continue to make money? We've seen this to be the case over the past 10 years through the cycle, pretty consistent with their corporate action policies. So the increase or the encouragement of the Chinese government for banks to lend to SMEs, we really haven't seen, and we don't expect to see a negative impact, or a too big of a negative impact to profitability, to balance sheet, and to asset quality.
Thank you, Mr. Derek. So I guess lending to SME is not a new thing, and this has been the Chinese efforts all along, and the Chinese government might continue to help provide support, and the upcoming quarter might be quite weak for all these banks. However, most probably it's due to the lockdown in China, but we don't expect to see a negative impact to all these banks' balance sheet. Thank you so much for answering the third question, Derek. So moving on to the fourth question. With China continuing its lockdown, according to the median forecast in the Bloomberg survey of economists, data will likely show retail sales decline more than 7% in May from a year earlier, while industrial output dropped 0.9%. So do you think China will show a contraction or it will recover in this quarter? And how do you think this will affect Malaysia? Maybe I'll direct this question to Chia Wei first.
Contraction. I don't think China will report a contraction in GDP. For two reasons. The first reason is China has been introducing stimulus, although it's been very slow and gradual, but they have been doing something. And on the other hand, what the government has done is also they have been fairly aggressive with their infrastructure investment. If you look at the infrastructure investment data, it has grown very strongly year on year. So that will help to cushion the weakness from domestic demand, which was badly hit by the lockdown. So I don't expect contraction. But more importantly is, just because there's no contraction, the question is really, how is the state of Chinese economy? I think it's still very weak because of weak domestic demand, and also because of the whole issue around China property. China property sales has been very, very weak because a few months ago there have been default by a few large property developers. Naturally, that will scare people off from buying property. So imagine if you put in a lot of money as deposit and you borrow money from the bank, you committed to the bank loan, and then the developers have cash flow issue and couldn't build your property in time and deliver you the house, then you will start with the mortgage servicing and your deposit will be stuck there. So clearly many people will say like, hey, I think I'm going to wait first. I'm not sure if I buy a property today, what will happen to the developer, whether I'll get my house on time or not. So no contraction, but economic activity is still weak. Going forward, the outlook, it seems to have improved a lot with the further loosening of lockdowns. Even restaurants have now allowed to allow dine-ins now in Shanghai. At the same time, the government has accelerated the stimulus. Even as of today, Premier Li Keqiang came out to say that, we need to do even more from what we've already done. So that's that. How will that affect Malaysia? Frankly, the bulk of the economic slowdown in China happened in March, April, and May. If there's any impact on Malaysia, we will have seen it already. And so far, the impact seems to be quite limited. Malaysia does export a fair bit to China, but so far, the impact has not been that big. Things still seem okay. And going forward with the reopening in China, I think things will improve. So I wouldn't worry too much about Malaysia when it comes to what's happening in China right now. If China continue to stimulate more aggressively, then it may have a stronger demand for Malaysian export, and that could happen. But so far, Malaysia, the key dominant export material is crude oil and palm oil. So those other smaller products to China, the impact is smaller. That's why we don't see the impact as much in Malaysia. Back to you, Nasty.
Okay, thank you, Xiao Wei. Maybe we can hear from Derek.
Yeah, I think Xiao Wei covered kind of some of the key points there. I'm going to make a bold statement here and really say that we're the worst effectively is going to be behind us. We're pretty much looking forward today. I think the big news really has been the news yesterday on the loosening of restrictions. Again, when we talk to kind of the companies or the companies that we invest in, industry experts, country experts, and even look at kind of the landscape across different markets. Again, the cap really was the restrictions or China's COVID-0 policy. With the direction of that being a bit more, I would call dynamic or strategic, in addition to the policies that have been put into place, both on the fiscal, the monetary side, but also looking at property, looking at consumption, and as Xiao Wei said, the infrastructure spend. There are different pockets within China that we believe are going to exhibit, above market growth. These are areas that we are focused on as, globally we see a shift in growth to slowing growth. What's going to be important is the demand side of that equation. So there are specific areas that we know China sees as strategic, where demand is going to be present. These are areas that we want to spend our time focused on. The second quarter figures that are going to come out in the next month or so, I think most investors expect them to be weak because of the impact of lockdown. So, as Xiao was saying, it's we know what to expect, but the question going forward is, how are things going to play out? And property is going to be one of those key areas. However, for us, we're looking at, again, that demand side of the equation. And we do believe that China has put into place policy to really encourage growth coming into the second half of the year. Now, execution is going to be the biggest question. So this is, I guess, a wait and see story, but we do understand and we do know, we are confident that in the second half of the year, all things being equal, again, I have to use this again, all things being equal, we do see potential green shoots for China in the second half of the year.
Okay, thank you, Derek. So I guess for China, there's not much contraction in GDP, and the state of the Chinese economy might still be very weak because of the domestic demand and also the China property sales. and also because all these large property developer being defaulted for the past few months. However, going forward for China, they seems to have more improvement with the easing of lockdown and also accelerated with all these stimulus. Although the second quarter figures might still be weak, but execution is still the biggest question, and but we still foresee that for the second half of the year, China might still have more improvements. As for the impact to Malaysia, seems to be quite limited, as mentioned by Chia Wei earlier, because Malaysia exports to China for a fair bit, but things seems to be still quite okay, and if things were to happen, it has already been factored in already for the past few months. So we probably will not need to worry too much about Malaysia. Alright, so moving on to our next question. As companies are seeking out alternative manufacturing hubs due to China's zero COVID policy, how do you think US will benefit from this? Maybe we can hear from Aiman.
Okay. How do I think US would benefit from companies looking, places looking to diversify away from China? Is that the question?
Yeah, because some of the companies are actually seeking out alternative manufacturing hubs due to China's zero COVID policy.
I see. Okay. Well, I don't think US has generally been seen as a big manufacturing hub, seeing as it's got its own problems right now, especially with the supply chain constraints, wages accelerating, and having difficulty actually getting people to fill that sort of staffing roles. So in that sense, we don't see the US as a viable alternative in that sense, and as such, we've not really position our portfolio in such a way. So we continue to remain somewhat defensive in positioning, given the volatility factor that I talked about earlier. And we've actually, to kind of tie it back to the previous question on the outlook in China, I guess one of the exposures for us, being a developed markets fund, was towards the Australian miners, and we would argue that the Australian mining companies for iron ore and were actually pricing in some degree of China stimulus already on the infrastructure side. So we've used some of the recent strength to trim our exposures there. That's my
Okay, maybe we can hear from Derek on how do you think India will actually benefit from this?
Right, great. So for us, aside from ASEAN, some of the ASEAN markets, we think that India stands to be one of the biggest beneficiaries of China's COVID, or of the China Plus One strategy. What we do know is that India has been trying to grow their manufacturing share of GDP. They've cut tax rates. They have introduced a lower tax rate for companies that are looking to establish domestic manufacturing bases. They've also introduced things like product-linked incentives for companies that produce domestically. So, in areas such as chemicals, such as electronics, garments, even, and also on ancillary auto parts, these are areas that we would expect Indian companies that produce domestically in India to benefit. One example that I can give is really the manufacturing of mobile phones. Over the past 12 years, the value of mobile phones that have been manufactured in India have increased sevenfold. India has gone from a net importer of mobile phones to a net exporter of mobile phones, and all this is taking place over the past, as I mentioned, over the past 12 years. So, although it's taken time, I think the government, through the policies and reforms, are really incentivizing and encouraging manufacturing within India. and given that companies are looking for, as you mentioned, alternative locales for sourcing, for buying outside of China. And this really came to light in March and April of 2020, when really Wuhan locked down, and Wuhan was globally one of the largest producers of chemicals. So, we really started to see kind of a shift. And India has mentioned been one of the beneficiaries there. The things that I've mentioned, aside from chemicals, ancillary auto parts, garment manufacturing, electronics, these are primarily low end. So we're thinking about things like air conditionings, other white goods. But as production-linked incentives continue, what we expect to see is a shift into higher value. So things like chemicals that help produce cells for electric vehicles, that help produce cells that go into solar power. So basically photovoltaic cells, PV cells. So all of this really is only made possible because of things like higher tax collection in India, stronger fiscal account, a stronger current account, and the timing of it seemed to have worked out quite well, because tax cuts were introduced in 2019. We had COVID in 2020. That really accelerated the pace of a manufacturing shift into India. So we do believe that given COVID, given China's COVID zero policy, when it comes to manufacturing or a China plus one policy, India stands to be one of the primary beneficiaries, aside from some of the ASEAN countries, ASEAN markets.
Thank you, Derek. Maybe we can hear from Chia Wei on your opinion that how will this affect Malaysia?
Yeah, Aiman and Derek have shared a lot of good points. So I just want to add a little bit about how it will affect US. Something that is interesting that we've been done. So what happened is some of the very high-end manufacturing is starting to move to US as well. For example, Taiwan's largest semiconductor company, TSMC, is building a plant in US. And that's just one example. Here and there, we will still see a few high-tech manufacturing plants being built in US. And the way that our global equity fund is positioned for it is really in a few industrial stocks. These are, when you hear industrial stocks, it's actually very wide. Specifically, what this industrial stocks does is one of them provide engineering service. So when you build a high-end manufacturing plant, or you build the infrastructure to support the manufacturing plant, you need this advanced engineering service. And there are also equipment provider, which helps to automate this plant. Because labor supply is an issue, and labor is very expensive in US, and where possible, these manufacturers would like to automate it. So these companies that provide automation equipment and business processes to this manufacturing plant, they are also benefiting. And not just automation, there's also increasing demand for industrial companies that provide decarbonization solutions. It's a big word, but essentially it means, let's say if you're a manufacturing plant, if you change to a more advanced equipment, you produce less carbon dioxide, or you consume less energy. So that's what it meant by decarbonization. And this, we believe, is a theme that will play out over the next 5 to 10 years. Yes, US economy has slowed down a lot, there's risk of recession, and industrial companies will tend to suffer. But we think beyond that down cycle, this industrial demand will be very, very strong, because this manufacturing reshoring back to US and to other parts of the world, it's something that will continue for in the next 10 years. Specifically, impact on Malaysia. Malaysia has already started to benefit from what my colleagues have shared with me when they visit those semiconductor companies in Penang. many of them are saying that they are seeing very, very strong order. And a lot of this order comes from, some of them comes from Chinese companies themselves who are trying to relocate or expand. That means having another factory or plant in Malaysia, in ASEAN. Because their end clients could be customers from US, from Europe. They want more diversification. That's one. And the reason has really been shared by Derek, the motivation behind that. Another motivation is that China has progressed so much to the degree that labor costs in China has started to creep up. And today, if you produce something in, say, Vietnam or India, it's cheaper than producing in China. And we can say the same about for certain products in Malaysia as well. So to answer the question, the impact on Malaysia is that Malaysia has benefited and will continue to benefit. I don't think we are anywhere near the end. 5 years from today, 10 years from today, I will think that more plants will be set up in Malaysia.
Wow, thank you so much to all the industry experts for this question. So I guess for US, as TSMC is building a plant in US, so the labor cost in US is also very expensive, so companies providing automation will most probably benefit from this. And decarbonization is also in demand and is also a theme to be played out over the next 5 years. As for Malaysia side, we might continue to benefit from this. We have already started to benefit from this, and we will continue to benefit from this. As Chia Wei also mentioned that the semiconductor sector has also been seeing a lot of orders, especially from all these Chinese companies. So we'll move on to the next question. As Chia Wei mentioned about the risk of recession on the previous question, maybe we can touch a little bit more on this. So Aiman, maybe we can have some of our views on this. Is the recession going to be deep and maybe long?
Well, yeah, we would. That's the trillion-dollar question right now. I think. Hopefully not is the answer, but nobody really knows right now. It remains data dependent, and it depends on how much the central banks all over the world are kind of impacting their respective economies' demand with the actions that they are taking. So at the moment, we are kind of wary of this risk, and we are tilting our positioning to be a bit more defensive. I think we are predominantly of the view that what we're seeing right now is a little bit of a bear market rally. So the US has sort of bounced a little bit from the lows that we saw earlier, and it can maybe continue, but we also wouldn't rule out a retest of further lows at a later point in the year. If the data actually worsens and people start really fearing a recession. At the moment, I think it's partly priced into markets. The SPX is trading at about 16.7 times, but the earnings have not been cut yet. So assuming an earnings cut comes through, then the multiple is actually a bit more expensive than what it's showing right now. So we are of the view that a recession is maybe 30 to 50% priced in right now at current levels. But we think that that there's further downside that can be seen in the short term, in the next maybe quarter or so. But if time is your friend and you can look past peak fear, then there's definitely opportunities to be had. So yeah, I hope that kind of answers your question, but it's basically a long way of saying nobody really knows how deep or shallow the recession is going to be at this point in time.
Yeah, thank you, Aiman. I guess none of us has a crystal ball to answer that question. However, a recession might still be happening with a 30 to 50% possibility. So we'll move on to the next question. So World Bank cuts India's financial year 23 GDP forecast to 7.5% amid the rising inflation. Do you think there will be further downside to the economy? Maybe we can hear from Derek for this question.
Yeah, that's a good question. That's also kind of what Ayman addressed earlier. That's kind of the $1 trillion question at this point in time today. What we're looking at really is, even at 7.5%, India will still be one of the fastest growing emerging markets globally. So 7.5%, even though it's lowered, we do understand that it's still a very strong growth number. The inflation is, again, as I mentioned, driven by energy and food inflation, as has impacted most other global markets. But because the government has strengthened, again, its fiscal and its current accounts, India is able to withstand a much higher oil price today than it was 3 to 5 years ago. If you asked us, the last time, or let's say three years ago, oil prices at about 80 to 85 is a level where, India would start to see a bit of pressure on its current account. According to our estimates, we can see India able to withstand about $120 oil price. Now, it doesn't mean that there's not going to be pressure on its fiscal and current accounts, but it's just the magnitude of it, the increment of it is going to be much smaller. Now, the most recent earnings season, we did see 25% year-on-year growth in the second quarter. Some of it has to do with the COVID base, because as we remember, last year in the first quarter and going into second quarter, India saw a spike in COVID cases. That being said, of that 25%, if we start stripping it and breaking it down, 12.5% of that is coming from the energy producers. But the other 12.5% were coming from other areas such as financials, consumer discretionary, and the like. When we look at India, the 7.5% is the real GDP growth rate. When we look at the nominal growth rate, nominal growth is at about 15%. So that is an even bigger number. This is where, and in times like this is where we believe having people who have spent time in the markets, who understand the markets, who understand the dynamics of the markets, are able to navigate these types of environments. So our view is really to look at either sectors or look at companies that can take advantage of this nominal growth. One sector is going to be financials. Other sectors or other companies are those that have very strong pricing power. So that inflation is going to have less of an impact. So when we think about the growth, not only just globally, but even from an individual market perspective, you are going to see quite a bit of divergence. This is where it's important to have people who understand how to navigate this dynamic environment, especially when there is so much uncertainty, especially when inflation due to higher food and energy costs. This is something we don't know when the expiration date to it is. These two factors are driven by geopolitical issues that are nearly impossible to forecast. I think it would be fair to say that I don't think a lot of market participants expected the Russia-Ukraine conflict to have dragged on to this point in time, which has resulted in, again, higher costs overall. Discussions went from higher rates, higher inflation to a global recession, right? And all that took place within basically a 2 or 3 month period. So I think having a good understanding of the markets is really going to allow for opportunities, as Ayman rightfully pointed out. But I know that's a very long answer to the simple question of, is there more downside to the Indian economy? But I wish I could say no, but I think there are a lot of moving parts here that us as investment professionals really need to take into consideration. And again, as Ayman said, I think during times of this type of uncertainty, it presents a number of opportunities for investors who have a longer-term time horizon.
Thank you so much, Derek. I guess, as Derek mentioned earlier, we can look at companies that can take advantage during times like this, especially like companies in the financial industry or with strong pricing power where inflation has less impact to them. So moving on to the next question, given the persistent inflation level, authorities would need to subsidize higher bill to taper down the inflationary pressure. So will this further stretch our country's fiscal balance and warrant for credit rating downgrade by the major rating agencies? Maybe I'll direct this question to Chia Wei.
It's true, firstly, as we all know, Malaysian government subsidize oil, subsidize chicken price, cooking oil, as well as subsidize our electricity bill, which is why most of us haven't seen the full impact of real inflation that's happening outside the world. Now, as prices of oil goes up, as prices of chicken, cooking oil go up, as well as when it comes to electricity, because Malaysia power generation, a big chunk of it comes from coal-fired power plant, and coal price has shot up a lot in the past 12 months. So, if all these prices are capped at the same level, this means that the government has to fork out much more money to maintain the prices. And what the government has done, fortunately for investors, not so fortunately for consumers, is that the government does not intend to increase the dollar amount of subsidy. All this while, they subsidize about 80 billion ringgit, and they intend to maintain it at 80 billion. But as prices of goods have gone up, what this means is that consumers have to bear it. Which is why, very recently, you are hearing things like subsidy for the ceiling price for chicken, the ceiling price for eggs will be lifted, ceiling price for cooking oil will be lifted as well. So consumers will have to absorb some of this price increase globally. And going forward, they are also talking about potentially removing fuel subsidy for certain income group. And we think that will happen eventually. Probably they won't be too aggressive before the general election, but it's very likely after the general election. So as consumers, we have to be prepared for it. Right now, the Malaysian government has committed to maintain budget deficit at 6% of GDP. They maintain it at that level. Because of that, it is very unlikely for major rating agencies to downgrade Malaysian credit rating. But if for some reason, for some populist reason, due to consumers' protests, the risk of losing the election, and government starts to say, hey, we will increase our subsidy to protect the consumers, to remain in power, we will raise budget deficit from 6% to 8% of GDP, then the risk of downgrades from rating agencies will be much higher. But right now, that's not the path that the government is taking. I think there is some sensibility from Bank Negara side as well as from the government, because they know that when you face downgrade from rating agency, it does hurt your bond prices a lot. There will be a lot of outflow, it will hurt ringgit. And when it hurts ringgit and ringgit depreciates, and because we import a lot of things from other parts of the world as well. So when ringgit depreciates, the cost of importing goods will also go up in ringgit terms. So it could even lead to further recession in Malaysia. Sorry, not further recession, further inflation in Malaysia. So raising the budget deficit to subsidize consumers can backfire. I hope that answers your question. So specifically, major rating downgrade? No, not likely, because government continues to maintain budget deficit at 6% now.
Okay, thank you, Chia Wei. Aiman, maybe we can hear your view on this.
On the impact to Malaysian market.
Yeah.
Being a kind of a developed market portfolio manager, we don't really focus on what the outlook for Malaysia is with respect to like credit rating downgrades. I think what impacts us the most is actually the FX. So I think being our end investors are obviously Malaysians, so our base currency for the fund is in ringgit, but we invest in developed markets, so US dollars. Earlier in the year, we actually thought that the ringgit actually looked oversold, and we took the opportunity to bring up our hedges, so selling forward US dollars. But since then, we've kind of tried to backtrack a little bit because our view is that it's going to be hard for Bank Negara to keep up with the rate that the Fed is expected to hike, especially as Chia Wei touched on earlier, in the face of an upcoming election. Maybe there's some political pressures to not hike as aggressively. With that in mind, and this is also something that Chia Wei mentioned earlier in the session, the interest rate differential is likely to narrow or maybe even go to negative, because the US being at 1.5 and Bank Negara's OPR being at 2, by the next meeting we might actually see a situation where the US rates are higher than Malaysia. So with that in mind, we actually took off our dollar ringgit hedges, and we are kind of waiting for a more tactical opportunity to re-hedge once we get further clarity from what Bank Negara can do. So yeah, I don't really have an answer with the credit rating agency question, but how it affects us more so is on the ringgit side.
Yeah, thank you. So hopefully we don't see a rating downgrade by the major rating agencies, as this will also hurt our bond prices, and it will also hurt the ringgit as well. So if ringgit depreciates, then our import costs will also go up, which might further lead to further inflation in Malaysia. So moving on to my next question, with the ongoing discussion on upcoming budget 2023, what is your view on this? Do you think that they will reintroduce GST to Malaysians? Maybe we can hear this from Chia Wei.
Before I answer your question whether it's likely or not likely, for a moment, let's assume if it does happen, if Malaysia does bring back GST, it will only happen after general election if BN wins with a convincing majority. Right now, internally, from our observation, we think BN is likely to win with a bigger majority. Will they bring back GST? I'm not sure. I'm not sure in the sense that it really can go both ways. Bringing back GST will help. And it's actually a step in the right direction for the economy, because the GST tax system is broader and it's much more efficient compared to SST. And if you think in terms of the tax revenue that's collected by GST when it was implemented some years ago versus SST today, the GST system managed to collect twice as much tax revenue compared to SST today. So if you introduce GST, Malaysian government will be able to collect more tax revenue, and that will improve their budget situation. They can reduce their budget deficit over the years. Earlier on, I shared that today is at about 6% of GDP. So if you bring back GST, it can help to bring down this number. And if you bring down this budget deficit number, it will help it will help foreign investors' perception of Malaysian bond market. It could also lead to some form of rating upgrade. So it's a good thing. Whether it will happen or not, it really depends. If BN wins, but it's not by a big majority, I don't think they can pull it through. Because somehow GST has always been framed as something that is bad for consumers. As you remember, the last time Pakatan Harapan won, part of the reasons why many Malaysians voted for Harapan was because Harapan promised to abolish GST, which he did. So you can see that from the perception of many day-to-day people in Malaysia, they still view that GST is a bad thing. So if BN wins with a small majority, they probably won't introduce GST because they will worry that they will lose upcoming election or lose the by-elections that happen or state election. But if the majority is big enough, convincing enough, such that they won't worry about losing power, then yes, they might do it. Yeah. So to your question, it really depends on how the election turns out.
Thank you, Chia Wei. Could you also add on what is the impact of GST?
What is the impact of GST? Consumers, compared to SST, the 6% tax, the GST will be broader. Secondly is for businesses, paying GST requires you to implement a different software system. It needs more work from businesses. Particularly some small businesses will find it challenging to implement the new software. So to consumers, you will pay slightly more tax. To businesses, you may pay slightly more, quite meaningfully more tax. But why is it a good thing for the economy over the long term is that it actually makes black economy or underground economy much more difficult. For example, there are a lot of small businesses where they don't report their revenue or they don't report fully what they earn with the intention to pay less taxes. With the introduction of GST, it makes it so much more harder to do it because you have to declare GST every time when you buy something from your suppliers, it has to be recorded because your supplier has to pay GST on it or you have to pay GST on it. So it does knock out a lot of this underground economy. Why is that good for day-to-day people like us who are not involved in the underground economy? Is because basically legitimate businesses compete with underground businesses. Underground businesses always have an advantage, which is cost advantage. They pay less taxes. So they can, for example, they can sell their product cheaper because they don't pay taxes, they don't declare their income. Legitimate businesses different. When we set a price, we have to think about tax expense. So when you knock these people out, it's actually good for legitimate businesses. And if you want a longer story, a lot of these underground businesses are backed by triads. So if you've experienced being bullied by triads before in Malaysia, then you know they are powerful because they make a lot of money from underground businesses. Yeah. So GST tackle underground businesses, it reduces the power of triads, and if you don't want to be bullied by triads as much, then it's good for you.
Thank you so much, Chia Wei. I guess if they were to implement GST, it will be beneficial for certain people and it might not be beneficial for certain people. So I guess in general, to help with the economy, implementing GST might be better than SST as mentioned by Chia Wei earlier. So moving on to some questions from the floor. It seems like China is likely to recover in the near term. So is it a good time to invest China right now? Is it considered as they have already reached the bottom and it's going to come up, slightly to move up right now? So is it a good time to actually enter the China market now? Maybe I'll direct this question to Derek, our expert on this area.
Thanks. No, I wish I had a definitive answer as an absolute yes. But what we see is there are a number of factors that allow us to be more constructive on the markets today than we were, let's say, a month and a half or even 2 months ago. One of them is basically the reopening. The reopening of the economy, the less stringent COVID rules. What we would expect is that it puts, it doesn't resolve 100% of these supply chain issues, but some of these supply chain pressures will be eased. That's kind of from a macro perspective. Obviously, you're going to see improvement in consumption, given some of the consumption vouchers, given rebates for cars, for electric vehicles, in addition to targeted areas that were impacted by COVID. So that's more on the, the economic side. From a market perspective, we have to think about kind of investor sentiment, the regulatory issues that have plagued the markets since the middle of last year, particularly from the tech and the internet side. We feel that we're past the negative policy. That's something that policy today is going to be more supportive than restrictive. The other part is that when we look at global investor allocation, it's near all-time lows for China. Earnings growth is expected to pick up. Valuations are again at levels that we haven't seen since some of the major crises over the past 10 years within China. So when we think about earnings, when we think about valuation, when we think about global asset allocation, and we think about the upcoming recovery as China opens up, you put those all together, and it creates a pretty good story. It creates a pretty good opportunity.
Thank you, Derek, for the answer. So I guess we do not really know when is the bottom, but however, it seems like things are picking up, and it might be a good time to enter the China market now. So the next question is, what do you think about the Malaysia market on the upcoming third quarter? And is the Malaysia market expanding or declining this year? Maybe I'll direct this question to Chia Wei.
Okay. Interesting that I always get Malaysian questions, although I actually manage Asian ex-Japan funds. But it's okay. From what I understand from what has happened in the Malaysian outlook is so we do monitor this thing called earnings revision data for Malaysia. Recently, it has deteriorated slightly. And the main reason is because palm oil prices have corrected, and palm oil stocks are pretty big in KLCI. So that has been a drag. On the other hand, the banking sectors continue to see very strong earnings trajectory and likely to do well. So you have banks likely to do better, plantation it seems to have deteriorated. Another sector which many people are interested in is, of course, the Malaysian semiconductor companies, the tech companies. Although small cap, but many people love it. The problem with that sector is that valuation was high and it's still somewhat high. And globally, when you look at semiconductor sector, they have derated because inventory level has gone up to a very high level. But demand for semiconductor has started to slow down. It's still growing, but the pace of growth has slowed down quite meaningfully. And going forward, people think that demand for semiconductor will continue to slow and some even think that the slowdown could accelerate. So that has hurt the Malaysian tech sector and has led to a derating. So we will be a little bit cautious on the tech sector. But I must say, when we meet the companies' management in Malaysia, Malaysian tech companies, all of them are saying things are still very, very strong. Order book is still very strong. They don't see any issue. So there is a possibility when results are reported for Malaysian companies, results could remain strong, whereas investor perception has declined. So that could be a little bit of a positive dynamic there. So I've covered the three sectors. The banks should be positive, plantation should be slightly negative, and tech should be, it's challenging from a top down, but bottom up could have positive surprise.
Okay, thank you so much, Chia Wei. Maybe we'll move on to our last question for today's Phillip Roundtable. What is your outlook of the developed market in Europe? Maybe we can hear this from Aiman.
Yeah, sure. Okay, so I think in Europe it's a little bit less clear at the moment for us compared to the US. I think in Europe, which is generally a value-centric market, there's comparatively less things that we like. And I don't mean to keep preaching the kind of the gospel of secular growth, but I think that's really where the opportunities have come back in light of how the market has performed this year. In Europe, we have continued to remain defensive, and I think the best companies to own there have been in the healthcare space. So you've got companies like AstraZeneca and Novo Nordisk, which have delivered strong growth this year, and they're defensive. They have been probably the hiding places for many investors, and I guess ourselves included. For that reason, Europe is also having to deal with its own challenges on energy dependency and the rise in commodity prices this year. So it's not kind of one of the areas that we are most excited about, I would say, compared to other parts of the developed world. But there are, the sectors that I mentioned earlier, mainly healthcare, where it seems to be still okay. And yeah, that's basically it for us.
All right, thank you so much, Aiman. So I guess when it comes to all these market uncertainties, we will still be able to find some opportunities as well in this kind of market situation. Before we end this session, I would like to thank our fellow panelists, Derek, Chia Wei, and also Aiman for joining us today and also sharing all these insights to our listeners today. So if you have any friends or family members who are also interested in this topic that we've discussed today, do let them know to visit our Facebook page at Phillip Capital Management Sendirian Berhad, because this video will be posted in our post wall site, so you can always re-watch this video and share it to your close friends and also family members. So with that, before we end the session, once again, our Phillip Investment Conference registration is already open, so do check out our page to know more about it, and we will see you again in the next Phillip Roundtable session. Thank you so much to our fellow panelists and also to our listeners, and have a great evening ahead.